The textbook next talks about the steps involved in using screen-based trading for buying and selling securities. There are 10 steps listed in the textbook, but that is because one of the steps has been divided into two, causing a little confusion. To understand the process better, you just need to remember these 9 steps. It starts with the selection of the broker and the agreement with the broker. Then opening demat and bank accounts, then placing an order, matching of the order, execution of the order, issue of contract note, settlement which happens on pay in day, and settlement which happens on the pay out day or T+2. And finally, delivery of the shares. I will briefly talk about each of these steps in the next few slides. The first step is the selection of the broker and the agreement with the broker. The investor approaches a registered broker such as ICICI Direct or a sub-broker and enters into an agreement. This agreement is a broker-client agreement, and a client registration form also needs to be filled at this time. In that form, the investor provides necessary details and information, including the income tax PAN number, which is mandatory, date of birth, address, educational qualification, occupation, residential status, that is, whether the investor is an Indian or an NRI, bank account details, depository account details, that is, if the investor already has a depository account, the name of any other broker with whom the investor is already registered, and the client code number with the other broker. In short, these are all the KYC or Know Your Customer details, which includes the ID proofs, the address proofs, and the tax details. If all the details are okay, then the broker opens a trading account in the name of the investor. If the investor does not already have a demat account and a bank account which can be used for the trading, then the investor will have to open a demat account through the broker itself and a suitable bank account. Then comes placing an order. The investor places an order with the broker to buy or to sell shares. The investor provides clear instructions about the number of shares and the price at which the shares should be bought or sold. The broker issues an order confirmation slip to the investor, acknowledging all the details that have been provided by the investor. Based on the order details, the next step is matching of the order. The broker or the broker system connects to the main stock exchange to match the buy or the sell order and the best price available in the market. Next comes the execution of the order. When the shares can be bought or sold at the price that the investor has mentioned, then it is communicated to the broker system and the order is executed electronically. The broker then issues a trade confirmation slip to the investor. Next is the issue of the contract note. After the trade is executed, within 24 hours, the broker issues a contract note to the investor. The contract note contains all such details such as the number of shares bought or sold, the price, the date, the time of the deal, the brokerage charges, etc. This is a very important legal document which is legally enforceable because it is like a contract and it helps settle any disputes or claims between the investor and the broker. When trades are confirmed on the stock exchange platform, a unique order code number is also assigned to each transaction by the stock exchange system, and this number is also printed on the contract note, and this can be used to track the order on the stock exchange platform. Next, there is the pay in day when the first settlement has to happen. This is the day when the buyer pays in the money to his broker and the seller delivers the shares to his broker's account. This pay-in on the initial settlement happens before the next settlement day on T+2 because the money and the shares are required to be in the respective broker's accounts for the stock exchange system to proceed to the next step, which is the settlement payout day on T+2. T+2 means transaction plus 2 business days. On the T+2 day, the exchange delivers the shares and makes payment to the buyers and the sellers' brokers respectively. This is called the payout day. The seller's broker then makes the payment to the seller within 24 hours of the payout day, since he would have received the payment from the exchange. The last step is the delivery of the shares to the buyer. The buyer's broker has already received the shares into his demat account from the stock exchange on T+2 day. So, if the buyer's broker does not already have all the required details, the investor provides the details of their demat account and instructs their depository participant to take delivery of the securities directly into their beneficial owner account or the demat account. The buyer's broker can then deliver the shares in demat form to the investor's demat account. A point to remember here is that the brokers, the depository participants, the banks, the stock exchanges, the clearinghouse and the depositories are all tightly connected. So the entire series of steps that we just discussed happen quite seamlessly. Sometimes some of these players may even belong to the same group, like you may use an ICICI direct account, which is both your broker and is also your depository participant, and it is connected to your ICICI bank account. So the process may get even more simplified.